Good morning, everyone. Today we have the most important part as our agenda, and that is Introduction to Accounting. In the previous lecture, you were introduced regarding the concept of accounting, its branches, and today we'll talk about its objectives and some accounting terms which we don't know as the technical term. जैसा मैंने पहले भी बताया, बहुत सारी चीज़ें, बहुत सारी बातें अकाउंटिंग में हम पहले से जानते हैं, बस ये नहीं पता कि वो अकाउंटिंग में इस नाम से जानी जाती हैं. एंड द मोस्ट इम्पॉर्टेंट थिंग, these are all related with our daily life. Okay, and thank you for such an overwhelming response of the previous video. The class 11 students, it was highly demanded, and you people have given a very good response in that regard. Thank you. And make sure, if you are the first time user, subscribe the channel, press the bell icon. Okay, and don't forget to get in touch by any means whatsoever. So let us start. Accounting, जैसा पहले भी बताया गया, it is an art of recording, classifying, summarizing, and interpreting. These four steps. Now, accounting has got some very peculiar, very special features. The first is reliability. It means the user have to be able to rely on the information. If I'm getting an information regarding a business which is authentic, then I'll be able to take some good decisions. So make sure the accounting makes sure that the reliability factor of the information conveyed to the users is maintained and taken care of. Okay, that is what is the first feature, first qualitative feature, that is reliability. Then comes understandability. Accounting has to be understandable. In India, the way we do the accounting, the way we present the accounts, it is very open to all, it is very objective, and anybody who wants information from that record or that financial statement can extract that information. All the decision makers, all the users are able to interpret whatever the information is conveyed, and they are able to use that. If that kind of a thing is not possible, accounting has no utility for us. Because of this very feature, accounting is able to present the information in such a way which is easily understandable and easily can be interpreted. Okay, so that any kind of relevance and any kind of reliability, yes, these two things are never lost. They have to be present, and they have to be able to be understood. Then only you can take some decision. Now, what is relevance? Accounting information has to be reliable, has to be understandable, but it has to be relevant also. That means it must be available effectively within time. If it is not available within time, it is of no use. Okay, then only the users are able to, you would be able to use it. Then comparability, the most important thing is, if I am doing well or my business is doing well, how will I come to know? I have to be able to compare my performance from the previous one or with the performance of others. Then only that comparison is possible. So, to be comparable, accounting reports must belong to a common period and some common unit of measurement and some uniform pattern of reporting. So these are the very few points that are relevant in regard to this comparability point. Comparability is something in which we are able to report the matters in the same similar formats of the same time period, and there has to be a common measuring unit. If you are going to compare a company's profit of previous year with the current year, both the years should be expressed in terms of rupees or some common currency. It cannot be that previous year you measured in dollars and this year you're going to do it in Indian rupees. Okay. Then comes objectives. Why do we do accounting? Obviously, to maintain the records of all the transactions. Then calculation of profit and loss. And not just this, you have to be able to depict, that is, assess the financial position. We have to be able to evaluate the financial position with, that what exactly the business is standing on. Then, not just this much, it has to be, accounting should be able to provide the information to the users. Okay. Now, there are some terms which we are going to use while we study accounting, and then if we are unaware of them, it is not possible to understand. So here they are. Capital. What is capital? The amount of money invested by the owner into his business out of his personal resource. It has to be his personal resource. If he has borrowed it from somewhere, it is a different thing. It is not capital. It has to be from his personal source. Then it is called capital. Okay. And because regarding this capital, I'm just telling you one small thing which we will elaborate later on. I'll explain you that later on. That owner and business, two different people, like Amit and company. These are two different persons, two different people. They're not same. How it is, why it is, we'll talk about this later on. Just remember this. I'm just giving you a thought. You keep this in mind. Okay, we'll discuss that later on. It is very interesting concept. It is. Then comes entity. What is an entity? Any kind of individual uh, existence or any kind of organization which is working and generating profits, like any that can be an individual, that can be any body corporate, that can be any cooperative organization, anything it can be. You see, there's few examples given. Any of these: Big Bazaar, Reliance Jewels, Tata, Tata Motors, anything. Okay. Then comes assets. These are the financial resources. Assets means what? In Hindi, what do we call it? Sampatti, property. Financial resources of a business that can be expressed in monetary terms, and it helps the business to exist and earn profit in the due course. Okay. And examples are goodwill, cash, bank, furniture, building, anything. All these things are your assets. And what are the liabilities? Assets are my property. They belong to me. And we are not talking about me. We are not talking about Amit. Children, remember, we are talking about Amit and company. We are talking about business. This is all belonging to business, not the owner. Yes, not the owner. Business. If I started a business, Amit and company, we are talking about Amit and company, not Amit. Clear? Now, what are the liabilities? The financial responsibilities or obligations of business, which the business is supposed to pay to someone. Clear? Then comes transactions. What are the transactions? Anything which is happening, any event, anything which is expressible in monetary terms between two or more people, obviously. Okay. They can be cash involved, they can be a situation where the cash is not involved. That means it can be a credit transaction. Okay. Then comes revenues. And see, I'm keeping these two terms because at times people confuse them, that they are the similar things. No, revenues. What are revenues? Amount of business earned by selling the product or the services, that is the sales revenue. And it is not just enough, it is also including few more things: commission, interest, dividend received, royalty received, rent received, etc. These are all called as income. The accounting term we use for that is revenues. So, revenues is a very big concept. Out of many sources of revenues, one is sales, and that is by the revenues received from selling of or providing of goods and services. And as we know, sales can be cash or credit. Then comes expenditure, spending money or incurring a liability for some benefit, service, or property received. The benefits arising out of it are long time period. They provide the benefit for long time period, more than 1 year. If it is within 1 year, it is expense. More than, it is expenditure. And it is called a capital nature expenditure because it is considered as an asset or treated as an asset. And what are the expense? These are the cost incurred in process of earning revenue, in the process of generating profits or incomes. Whatever we spend is expense. Clear? Then comes profit and gain. Profit. What is profit? When the revenues are more than expense. This is revenue, this is expense. If it is like this, it is profit. And it increases the capital or the investment of the owners. That means it is, I'll say, inflating the balance of capital in the business. What is gain? A profit which arises out of transactions which are incidental and rare in business. That means what? Profit is something which is regular routine, but gain is something which is not a regular routine. Like if we are not going to sell any fixed asset very soon. That okay, fine. Suppose I am sitting alone and sitting free, and I thought of selling off an asset. Is it low? Is it so? No, it never happens. Selling of a fixed asset, or if we are going to, there's some legal suit going on and we won it and we are getting some compensation. Is it a routine activity? No. So profit is a routine activity here, and this one, gain, is not a routine activity. Clear? Then comes loss. As I told you, revenues, expenses. It is profit. And it happens like this: revenues, expenses, it is loss. And if the profit increases the capital, it will decrease it. Clear? Then comes discount. It means when the prices are reduced. When the prices are reduced for the buyer. Of what? We are reducing the prices of what? The goods and services that we are providing. Okay? It is of two types: trade discount and cash discount. Trade discount is provided to encourage the buyer to come and purchase the things or services. Cash discount is given or allowed at the time of cash payment. If the customer is paying, we will provide, otherwise we will not provide. Okay? And then the class comes to the end. Today we have covered up some important terms. Few more are left, which we will cover in the next class. Okay? Till then, stay healthy and make sure you copy down all these notes. Okay, these are very important and the best possible content in this minimum possible words. They are easy to learn, easy to understand. God bless you, and don't forget to get in touch.